See, last week I needed some clothes, so I went for shopping. I went to multiple stores including Zara, Zudio and Westside. I bought clothes from each of these stores, and it was only after when I came back home I realized that I paid the money to the same company. This Tata company makes more than 12,000 crores in revenue and might become the biggest fashion company of country very soon. A company that is not famous by its own name but is behind running 3 of the biggest fashion brands of country: Zudio, Westside and Zara. The company I'm talking about is Trent Limited, a retail masterstroke by Tata Group that has given its investors almost 2000% return in the last 5 years. In this episode, we'll dive into the 3 core insights that Trent Limited has cracked to become the ultimate fashion retail king of India. But if you're new to the channel, then hello. You've landed at GrowthX, an invite-only community of over 3,000 members who are product, marketing, business leaders, and also founders from the startup ecosystem. Coming back to Trent, let's get some context first, right? Trent has got many investors excited about investing into the company recently, but this is a 25-year-old company that we're talking about. So when you compare Trent with giants like Reliance Retail, Aditya Birla Fashion, or Shoppers Stop, Trent stands apart in terms of everything, be it in terms of brand impact, scales, or even margins. It has an entire universe of companies in itself. So if you split this universe open, you can find 2 types of companies. One is self-owned and other are the joint ventures. In self-owned stores or brands, they have Westside, Zudio, Samo, Xsite, which is a cosmetic brand by the way, and in JVs they have Zara, Star Stores, a store that does grocery retailing, and Booker, that does groceries for hotels, restaurants, and small businesses. But in this video, I want to talk about the fashion masterstroke only. Why? Well, because Zudio, Westside, and Zara together make more than 90% of the company's revenue, and this is what we will talk about today. Trent opened Westside in 1998, formed a joint venture with Zara in 2010, and then eventually started Zudio in 2016. These 3 main pieces are part of a master plan. But the question is, why 3 brands by the same company together? As this could have done more harm than good, right? By destroying each brand's market share. Well, this is exactly the first insight that I'll be talking about, which is the house of brands insight. Tata realized one thing very clearly. India is divided into multiple layers and segments. One is Poland, one is Singapore, and one is Mexico. And now all of these are very different from each other. These 3 Indias have different per capita incomes, different wants, and even different aspirations. So basically, different users in India love different brands. So while the Westside revenue for Trent was increasing constantly as they expanded, they understood one core thing, that they can never make Westside the Maruti Suzuki of fashion or the big bazaar of retail. Why? Well, because the average selling price of Westside, which is about 1,500 to 2,000 rupees, is not through which they can capture the tier 2 and tier 3 cities, and is also not something through which they can capture the most premium segment of society. Westside was always somewhere in the middle of the customer's value aspiration pyramid. So to penetrate into the upper pyramid of the market, they did a joint venture with Inditex, a Spain company, to help the Zara brand scale in India. And to penetrate the lower pyramid of the market, they launched Zudio. Now all of these brands have different average selling prices by the way. Like Zara has an average selling price of 2250, Zudio has everything under 999, and Westside, as we've already discussed, has an ASP of 1500. But the most interesting thing is that the biggest success is coming from the most lowest margin brand that they have, which is Zudio. Zudio went from contributing 2.8% to company's revenue to more than 56% right now. They make around 7,000 crores, which is more than Westside itself. The company launched Zudio as a separate brand because of one simple reason: positioning. Because if they would have offered the similar Zudio-like products in Westside, they would have confused the consumer of the aspiration level that they have for the brand. Because Zudio products are a little lesser on quality. And this eventually would have destroyed the brand reputation that Westside had created in the last decades. But Trent realized one thing very clearly, that India's 50 billion fashion market is so big that it would have just been foolish move to not go after the bigger piece of pie, which for your information will only grow as India's middle class is rising and people have started spending more part of their incomes on how they look. That's why Tata's masterstroke was to have different brands selling different quality products at different margins, each having different marketing communication. And there's a lot more to this house of brand insight, but before we get into that, we have something super special for you. Thesis by GrowthX. See, the idea building behind Thesis was simple: to uncover where the value truly lies in India's fastest evolving and most disrupting sectors. Because we know that many sectors are new, nuanced, and have always been covered just from the surface. In the first edition of GrowthX thesis, we covered the Indian EV landscape in depth. We spent last 6 months building this comprehensive report that runs into 30,000 words and more than hundreds of pages, by the way. We talked to multiple founders, leaders, and investors who have actually skin in the game and taken a bet to disrupt this nuanced sector. We cover everything, be it the macros of Indian market, the Indian EV policies, the category splits between two-wheeler, three-wheeler, and four-wheeler, what's happening around globally, the EV value chain, the battery and charging infrastructure, the cost angle, and even the supporting proxy industries, and so much more. And because we love you, we are giving away this thesis for free. You can access it from the description right away. Happy learning. Coming back to the house of brand insight. See, TATAs have used positioning very smartly, and that is the reason why you would never find either Zara, Westside, or Zudio in the exact same location. In fact, even if they are in the same mall, you would find them in the different corners of the mall. Zara would be in a section where other premium brands are located, and same would be for Zudio and Westside. All of them have different campaigns and all of them talk different to the customers. For example, in Zudio, you would never get a discount because the margins of the brand are already laser thin and the main play is of the volumes. Similarly, in Westside and Zara, both of the brands have an online presence and they want to serve the customers via online channel too, which again is something that they are not at all doing at Zudio. In fact, 5% of the Westside's revenue is coming from the online channel, which is literally zero in case of Zudio. But now that I just talked about stores, I need to share some interesting nuances on how the company is scaling. Which brings me to the next insight, the insight of scale. See, scale is one of the most brutal parts for any Indian business. It is a decision which involves big investment and also involves right operation. In fact, one of the biggest rise and falls in the country has also been in this sector. We all know this. It's Big Bazaar. And Trent has cracked two things really well in scaling themselves. And I'll be only talking about Zudio and Westside here because Trent has often said themselves that Zara is only a financial partnership and not a strategic partnership. So coming back to the two factors, see, one of them has been the location focus and second has been the retail model, and we'll discuss both. For context, in 2019, they had 150 Westside stores and 44 Zudio stores. Now you'll be shocked to know that this number has increased to 232 stores for Westside and a massive 545 stores for Zudio. This is insane but deliberate. Why? Well, because they have understood that Tier 1 India is only like 10 to 20% of India, and you need to penetrate Tier 2 and Tier 3 cities if you really want to capture the Bharat opportunity. And it's obvious, right? Since the audience for something like Zudio is way bigger, they went bullish in that. And if you look at the latest store addition data, you would see something surprising, that the growth of both Zudio and Westside are also happening in different parts of country. They both are going bullish, but on different states as per the chart that you can see here. Now this is a super smart pan-India expansion strategy by TATAs that many big retail giants should take a note of. Plus, if you compare Zudio with another Tier 2 and Tier 3 focused retail companies like V-Mart, for example, who are making more than 2,000 crores by tapping into this market, by the way, Zudio is still yet to open stores in many of these cities, which just shows the runway that this brand has. By the way, for Zara, you'd be shocked to know that they are only operating roughly 25 to 30 stores with Trent in India, which is negligible compared to Zudio and Westside. Coming back to the second part of the scale puzzle, which is retail models. See, there are a number of retail models that you can use as a brand to expand your business. This is on the basis of one party owning the store and paying the lease, another party running the operations of the business. Ideally, there are 4 models: the COCO model, the COFO model, the FOCO model, and also the FOFO model. And as you can see on the screen, that each model is different and has its own advantages and disadvantages. So different companies take choices based on what suits their brand and balance sheet more. Now Trent has very smartly gone for the FOCO model for Zudio. Here, the franchisee partner, who could even be you and me, by the way, if we meet certain requirements, pays the lease, owns the store, and take a revenue share of 16% from the total store revenue. And Trent, on the other hand, only does the operations of the store and ensures that stores are being run properly and the turnover per store does not get affected. A great way to scale because company does not have to spend extensively on paying the expensive leases and taking a hit on the balance sheet. By the way, different Indian companies have gone for different models, like Fab India and Aditya Birla, a company which owned brands like Reebok, Peter England, etc. Both of them have gone for COCO model, which is a company owned and company operated model. While a brand like Manyavar has gone for even more delegation and has gone for the FOFO model, which is a franchisee owned and a franchisee operated model. But Trent's strategy of using a FOCO model is a great mix for being asset light but also not compromising the quality. Also, after doing a little bit of digging, we found that Westside is doing a mix of both COCO and FOCO models. This is a great balance that they're trying to go after. But why am I talking about this? See, by going for a FOCO model and by opening Zudio in non-premium locations, they have been able to save a really good amount of money and have improved their margins. So their EBITDA, which is a profitability metric and can be calculated with this formula, has almost doubled in the last 5 years. So while other companies had to take debt for their store expenses and for operations, they have been able to do it very smartly. But now that we've talked all about this, what is actually happening at the store level? What are they cracking in the operation game? Which is the next insight, which is cracking store level execution. See, both Zudio and Westside are extremely highly efficient stores. By the way, to judge a performance of any retail store, you only need two parameters. One is the same store sales growth, which is to judge whether the sales are growing from the same store or not. And second is revenue per square feet, which judges the sales from a particular area of store and judges how efficient your store is. And if you look at the metrics, their same store sales growth has significantly improved over the years. They are making more money from the same stores every year. And if you talk about the second metric, revenue per square feet, they are doing 18,000 rupees per square feet for Zudio and 12,000 rupees per square feet for Westside, which is way above the average of 10,000 rupees per square feet for the industry. But how are they doing it? The answer lies in their private label and fast fashion approach. In fact, this is where the Zara partnership has been most helpful for them. Trent has learned smart fashion from one of the biggest retailers of the world. See, Zara is one company that brought the concept of fast fashion to the world, and it is very simple to understand it. It is a way to get trendy throughout the year by not putting out clothes in front of the customers on monthly basis, but putting out collections in front of the customers on bi-weekly or weekly basis. And this method basically involves producing more clothes at higher speed basis on the basis of quick trends that are happening on the social media and putting out different varieties in front of the customers. So let's say Zara launches a t-shirt on basis of a new trend that's happening on Instagram, and that t-shirt starts selling more. Zara would push more quantity of that t-shirt into the store. And this is exactly how this works. But the downside is that it leads to more cloth wastage, and we'll talk about it some other day. But in a nutshell, they have learned how to execute the concept of fast fashion very well to make sure that they stay relevant for their customers. Also, they have taken the approach of private labeling, where you would not see them selling other brands' products at their own outlets. It's pretty different to the approach that other retailers like Pantaloons and Shoppers Stop have taken. And the idea is simple: make more people come to Westside and Zudio, not for other brands, but for the trust of Westside and Zudio itself. Also, for context, private labeling does not necessarily mean that you manufacture your own stuff too. You can get it manufactured from third parties and smash your own labels over there. It just leads to better margin and also possibility to create bigger in-house brands. Like Westside now has more than 5+ in-house brands for them, which is pretty amazing, as people have now started recognizing the brands of Westside separately as well. But there's more to this, as they are successfully cracking another lever too, which very few people are talking about right now, which is cracking the magic of upselling. See, when you go to a Westside store, you go there to buy clothes, right? But you are later upsold perfumes, wallets near the counters, shoes in the end, and many more stuff too. In fact, they even upsell you the Westside membership, which you would probably hardly ever use, but you still might end up buying. And the reason for customers buying these wallets, perfumes, or even membership is simple. See, customers are lazy. You and me both are lazy. If we are shopping at a particular space and we have spent some money, we think that why not spend some more and get done with everything at the same time. And this is where they're doing a great job. In fact, they now have more than 1 crore customers who have bought their Westlife membership and are confident on the brand. So these were the 3 insights that have helped Trent become one of the greatest retail companies in India's growing consumer market and helped them make more than 12,000 crores in revenue. Don't forget to check out the GrowthX EV thesis from the description. I will see you in the next one. Ciao.